Welcome to the Startup Leader Show, where we learn lessons from startup founders and executives. I'm your host, Lisa Dreher, and I'm excited to introduce our guest for today, Emanuel Zareh. He is a partner at Emless Venture Partners. Welcome to the show, Manny.
Hi, Lisa. Pleasure to be on. Thank you for having me.
Absolutely. Thanks so much for being here. Gosh, it's amazing. It's been about 2 years since we last spoke on the show, and I'm really excited to talk to you because things have changed pretty dramatically over that time. Can you talk about what some of the biggest changes have been in terms of the investment community?
Sure, it seems like it's been a completely different world, a 180 from when we last spoke, right? And I would say that there's been several big changes. Clearly, the venture landscape has been responding or is responding to what's occurred in the equity markets and in the general macro environment, which is softening to say the least and slowing down. So, just a couple of statistics, if you will, to point out the differences. From 2010 to 2022, the Fed funds rate averaged 78 basis points. Today, we're at 4.5%, right? The 10-year yield in that time span from 2010 to 2022 averaged 2.25%. Today we stand at 3.56%. ISM new orders, factory new orders that we look at as a leading indicator from 2010 to 2022 averaged 56.5%, 56.5 in expansion territory. Today it's at 45 in contraction territory. And quantitative easing, if you will, per year from 2010 to 2022, on average was 486 billion. This year we're contracting by 1.1 trillion. And what's most surprising to us is that the price to earnings ratio hasn't even changed. So from 2010 to 2022, the average PE in the market was 16.8, and now the PE ratio is 16.9, teetering on 17 times. So very different dynamic, right? 20 as we enter 2023. So what does that mean for the venture world or investors in my seat? When we spoke, I would have not a lot of time to do my due diligence, unfortunately. Rounds would get full pretty quickly. And I was always battling against FOMO, fear of missing out on deals and opportunities. And we stayed very disciplined, and it's worked out very well for us. But what we've now seen, the environment's completely changed, where there's an elongated time for us to do a complete due diligence process, which is, I think serves not just the interests of ourselves and our investors, but also the founders, because now they have more credible investors on their cap tables that have done the due diligence and the deep work to help them. Number two, a lot more of my time is spent on restructuring of our portfolio companies. Um, Founders have, I believe, and we have a great set of founders, are much more seeking advice, or much more open for suggestions. And some founders got caught off guard by the changing fundraising environment, and we had to help them reduce their burn in a very meaningful way and try to get their cash, try to become, hopefully profitable by the end of this quarter is what we're hopeful for a lot of our portfolio companies. Clearly, the number three thing is a valuation reset. When we spoke, it seemed to be like every round was getting a bit higher and higher, with money being thrown at founders. That's no longer the case. We're seeing meaningful cuts in valuations, which you need a correction.
Mhm.
Number four, founders' attitudes have really changed, and and it's one more. It's always been collaborative, but much more collaborative now. I think they understand that there's wisdom in crowds and wisdom in their cap tables, and they're much more open to the suggestions, and their attitudes on growth has changed versus profitability. And very lastly, the biggest change that I've seen is the robust opportunity set in the secondaries market. A lot of companies, they're trying desperately to raise capital, and some venture funds are trying to get out of some of their positions. And there are great opportunities out there that are now being offered at 20 to 30% of their last valuation, which is which I don't even know if that's appropriate, but it just is a sign of the times, right?
Yeah.
Not necessarily too surprising because when we spoke, if you recall, the SPAC market was on fire, right? And in a sense, the SPAC market to me represented venture capital opportunities that were now being publicly traded. And I believe the SPAC index since then is down over 90 to 95%, right?
Right.
So a proxy, if you will. But those are some of the changes, the biggest changes that I've seen over the past couple of years since we last spoke.
Amazing. I mean, just such a dramatic change. So, do you see this time as a real big opportunity then to find investments that maybe wouldn't have been as available? And then also, like you're saying, the opportunity to review those opportunities, even, to, I guess, a deeper extent than maybe you would have.
Well, venture funds would be silly, in my opinion, to take their foot off the pedal and not invest now. This is what you're waiting for, right? A complete reset in the market, better valuations, better terms, more time to due diligence. And capital will find the best founders, and the best founders will shine in these periods. It's easy to be a great stock picker when everything's going up and to the right. It's easier to be a good founder when there's a ton of cash being thrown at you and your company to help grow and to help take market share. It's a lot harder when things are choppy.
Yeah.
So for us, this is an amazing opportunity to invest. It's a phenomenal time to see who's going to shine and to get opportunities at a much better price, if you will, much better valuation. Also, and I think it's starting to percolate in some of my conversations, a trend that I think will begin and will endure, especially for consolidation. There are ample opportunities out there to take two, three, or several companies that are competing in the same space and perhaps consolidate them, take out some costs, and now you have a bigger player in a still attractive market long term. And you
Hmm.
right size it, you put in the right management team and right board in place. We saw this playbook. It happened from '01 to '05. And what happened after that? Microsoft, we had Google, Facebook, some of the best companies in the world, right, were
Yeah.
born in that period or survived that period. Amazon being a shining example, right? So we view this as a similar opportunity. It'll be tough, it'll be long. There's not going to be a quick snapback, but this is the time you invest. Like Warren Buffett said, got to invest when there's blood on the streets. I don't think we're there yet. We may get there, but this is a great time to keep investing.
Yeah, absolutely. Wow. So it sounds like, in terms of the investment community, in general, investing hasn't come to a full halt. It's just maybe changed a little bit.
It's definitely slowed down substantially,
Yeah.
and completely changed. Some of the hedge funds that were known for their public market expertise that got involved in venture, I believe, have taken their foot off the pedal. And that's not necessarily a bad thing, right? I think they want to take a pause and see what's going to happen in the environment. And it allows some of the more seasoned venture capital firms to take the to take the wheel by control and perhaps come in and, like I mentioned, get into some really interesting opportunities at better valuations and help drive some strategic initiatives at those companies to survive and advance in this environment. I don't look 2021, 2020, those were some bull market years that we may not see for another decade or at least for another several years. Um, Hopefully we'll return to a trend line of capital being deployed. I don't think 2023 will be that year. Perhaps 2024. Investors need some kind of clarity on what's going to be happening in the macro landscape driven by the Fed. And it's extremely difficult to put capital at work with a lot of confidence when there's a tremendous amount of uncertainty. But if
Hmm.
you can get into those opportunities, those investment opportunities, dig in deep, take your time, offer a plan to help restructure those companies that need it, well, then then you make yourself a nice little package for the next several years. And by that time, the capital markets will definitely be open, whether it's IPO market or you'll see consolidation come back into place with acquirers in the public market.
Yeah. What advice would you give to founders that are looking to raise funds in this environment?
It's a great question. the name of the game, like I mentioned earlier, is survive in advance. So, take your burn down to zero. That make your default status alive, for sure. And look, you have to have dexterity. Reach out to investors that you may have spoken to in the past that didn't get allocation to your round, or that for whatever reason they pass up on the opportunity, whether it's some based on valuation concerns, etc. Re-engage with them. The most likely source of capital would be from your existing cap table. They're going to have a big interest in it. Offer them, very attractive terms if you need the capital, and try to get more investments from them. This way, you still keep your cap table clean. You don't have to retell the story, and perhaps offer up something like board advisory seats or even a board seat in order to gain from their knowledge.
Hmm.
And lastly, there's been a lot of conversation about venture debt. Um, I think it's something that should be taken seriously, and founders should be at least analyzing those opportunities. But I would be very aware of that. Leverage is not a friend when numbers are going the wrong way.
Hmm.
And
Yeah.
so you have to explore all opportunities. I think starting with your existing cap table is the best, but you have to offer the existing cap table some kind of carrot in order to get the new capital coming in.
Right, right. Yeah. Are there other alternative sources of funding that founders should be looking at?
Well, you could consider revenue-based financing, right, as an option. Not necessarily a fan of that per se, but desperate times do call for desperate measures, and like I mentioned, you got to do whatever it takes in order to be able to keep the company alive, and that's really the name of the game, especially for early stage companies. Just live to see another day, and the market will change, and you never know, what opportunities could arise.
Mm.
But I think also there's not only venture funds are sitting on a tremendous amount of capital that they haven't deployed yet, but corporate venture funds are very interesting opportunity sets for founders to raise money from. So if you're in the insurance tech universe, you may want to look at the insurance companies that have a CVC arm and try to raise from them. I
Mhm.
think it behooves founders to go to sources of capital that are focused on their specific industries and niches. They'll be much more receptive and offer collaboration in order to help grow the value of the company.
Mhm. Mhm. Got it. Okay. So, if you could make one prediction about the future, given kind of all of this uncertainty, what would that be, and what would the implications be for startups?
Well, I think we touched upon it earlier. For me, my prediction is I don't expect a snapback to 2020 to 2021 levels of activity immediately. Trench down, and I would recommend to our founders or founders in general that this could take a while, another 12 or 18 months of this. So that's number one. And number two is have confidence that this is the time when the best businesses of the future are being built. And if you're talented and you're hungry and you're motivated and you got traction and you're keeping your burn to a minimum, capital will find you, without a doubt, right? So it's just that's and I guess so that is my prediction. The next Googles of the world or the next Amazons of the world are being built right now, in the what seems to be a very gloomy backdrop for investing. But we should turn it on its head and realize that, yeah, maybe it's not going to be pleasant for the next 12 to 18 months, but we should be thrilled with the potential of what comes after those clouds.
Absolutely. So, any other closing thoughts before we close our interview for today?
Sure, I would just close with investors are still very focused on the founders and their teams. While the landscape has changed a lot, I still think the ethos of many venture capital firms remains the same. Just looking for the best and talented founders, those who are hungry, those that have the dexterity to change and adapt. So we don't need wholesale changes in terms of like the kind of emotional quotient or intelligent quotient that founders have, it's just going to be a longer road to those exit opportunities. But just stay on the course. And another key lesson for me this year that I'd love to share is that I gleaned from 2022 is investors and founders should work in collaboration. What I found is sometimes founders are a little reluctant to go to their cap table because they may be ashamed, quote unquote, of something, or they may not want to represent, numbers or results that haven't been going the right way. That's
Mhm.
exactly the time to engage with your investors. Transparency is so critical in these days, in these types of times. So, be transparent, be open, don't be ashamed. We all make mistakes. I've made them. I continue to make them. That's part of this journey, but it's really a team effort. And if everyone approaches these kind of investment opportunities as a one team, one dream mentality, then it's going to lead to great success for all parties involved.
Wow. Wow. Fantastic advice. Thank you so much, Manny, for being here today. If you want to learn more about Endless Venture Partners, where should people go?
Please visit us at endlessventures.com and feel free to reach out to me at Twitter. My handle is Zareh, or on LinkedIn.
Excellent. Well, thank you so much for being here today.
Thank you,
And
Lisa.
hopefully, the next time we get together, we'll be talking about some of those next Googles and Amazons.
You know it. Have a wonderful day, and thank you very much for your time.
You too. Thank you.